finance ministers and international lenders have begun a two-day meeting in Cyprus. They're focusing on a potential bailout for Spain, Greece, and the limitations of the powers of the proposed banking supervisory body. Jack Barton has the latest.
EU finance ministers arrived at their informal meeting in Cyprus with the aim of getting the wheels moving again on the bloc's troubled economy. The first talking point was the proposed banking supervisory body that could take charge of all of the euro area's roughly 6,000 banks. Brussels wants non-euro EU banks to be under the European Central Bank scheme as well. But Sweden made clear its position.
It would be very problematic to see the ECB taking over supervision of our banks.
And in the euro area, Germany insists only 200 systemically important banks should be covered.
You don't need to cover all the banks, but you need to cover, let's say, 200 banks. With 200 banks, you get roughly 95% of all the assets. That would be enough, and I could imagine that this could emerge as a compromise.
With its borrowing costs falling, Spain did not have to ask for a bailout just yet. Everyone agreed the recent green light for the permanent bailout fund, along with the European Central Bank scheme to buy unlimited amounts of troubled short-term debt, has finally brought some calm to the bond markets.
This momentum, which is clearly positive, will be maintained in order to take stock and consolidate the gains that have been recently seen on the markets.
Greece was told that inspectors from the so-called Troika of the IMF, European Central Bank and the European Commission would need at least another month to decide whether Athens is eligible to receive the next tranche of its bailout. But with all the newfound calm in the air, a softening on Greece was clearly evident. On the sidelines, ministers conceded Greece is not meeting its targets, but that Athens is likely to be granted more wiggle room in reaching them, but not more money. Jack Barton, CCTV, Cyprus.